Hello, and welcome to Financial Fridays with Dawn, where I come to you each and every Friday to empower you to live a happier, healthier, and wealthier lifestyle. So today's topic is going to be geared towards business owners, specifically business owners who are capital-intensive businesses. And I took a lot of great notes on this, so you may catch me reading from my notes because I don't want out on any of this great information for you. So one of the greatest challenges facing every business owner out there is how do they get the money out of their business in the most tax-efficient manner? So that's a major concern. And most businesses who are capital-intensive businesses, they're missing out on one of the most lucrative ways to actually save taxes and increase their personal rate of return on their investments. So first let's talk about the 5 ways that you can get money out of your businesses. One is through salary, dividends, withdrawals, and deductible loans, and also deductible business expenses such as health insurance, retirement plan contributions, utilities, etc. But the one business expense that's most underutilized is the loan interest. And loan interest is any loans that you make to your business, you could deduct the interest. So that is a great way to reduce your taxes and a great source of income through that. So let's take an example. Let's take a dentist's office or a restaurant owner or a car dealership, because these are very capital intensive businesses. So for example, let's see, we have to assume that the business is profitable. Let's say the piece of equipment that you're planning on buying is $100,000, and then you should have $100,000 or more in investable assets outside of the business. So now let's use in the conventional planning, there's basically 3 ways that you could finance this. 1 is pay cash, 2 is lease the equipment, and 3 is borrow from a bank or a financial institution. So now let's take a little bit look deeper at all of those options. So 1, if we pay cash, we're losing that liquidity of that $100,000 and what that $100,000 could have earned for us, known as opportunity costs, which all the business owners, you're very familiar with opportunity costs. So let's take that out 25 years. So that $100,000, not only did you lose that $100,000, but let's say just at an interest rate of 4%, that's a loss of $166,583 of interest. Now you can use the Section 179 deduction, which is accelerated depreciation in year 1, so that $100,000 will be fully reduce your income. You can get a tax deduction for that. So that's a huge tax savings right there. So 2, the next option is leasing. So this requires a fixed payment based on the cost of the car and the value of the life that's going to be left, the useful life, and the salvage value at the end of the term for the equipment. So typically it's about 12% or more that a finance company will charge you for this. So let's say that you have a lease term of about 5 years, and at the end of that term, the fair market value is going to be 0. So now you would have paid $133,466 in 5 years. And each year you were able to deduct the full lease payment and interest, which is about $26,693 a year in tax deductions that you could take. And then the third option is borrowing money from a bank or a financial institution. So let's say you could go borrow a loan, and it's a 4% interest rate for 5 years again. So you would pay approximately $110,409 in interest. And again, using that Section 179 deduction, you could deduct the full $100,000 plus the interest you paid every year. So those are the conventional options. But there's something that you may not be aware of, which is a non-conventional planning technique, which is a great idea. So basically what you do is you take a loan from a bank or a financial institution, and let's say you have your own personal investment account. Let's say it's earning 4%. And you could get a loan from the bank for 4%. So you collateralize your personal investment account to get that loan for 4%. Then the business charges, here, I just want to make sure I got this all correctly. So the business charges 4%, the bank charges 4% for that loan for 5 years for this fully collateralized loan. Now your account continues to grow and earn interest that is uninterrupted compounding interest. So that's a great deal. And here's where it gets really good, because there's no limit on what you can charge for your business for the interest, for the loan. So, but it should be reasonable, otherwise you don't want to get into trouble there, so make it reasonable. So let's say you loan the business for 5 years at 12%, And at the end of the 5 years, you can either renew that note or you can set up structured payments to pay back the principal and interest. Now, the business gets a deduction for the interest paid and that Section 179 deduction of the $100,000 in the first year. Now, since the money was paid out to you as interest, there is no employment taxes. So also there's no Social Security taxes, no Medicare taxes, or unemployment taxes. So this could be a savings of a minimum of 2.9% all the way up to 15.3% or even more. Now, when you receive the income, it is going to be taxable to you. But if you borrow the money like we discussed about before, you can get the deduction. So in essence, that 12% loan, of that, only 8% is actually taxable to you personally. So let's summarize in that example that I used. So let's summarize. So the business pays a 12% loan, 12%. You pay out 4%, but you get that 4% back on your money because that money that you have invested in your personal account is still earning the 4% uninterrupted compounding interest. And then depending on where the money is invested, you could actually get that money tax-free. So the net result is you get a 12% investment gross, which is pretty great because you're getting all that deductions. Now, I'm not sure if you know of any other place where you can get a 12% return on your money. And here's another question. Don't you think your business is a great credit risk? If you're building it and growing, I would think that you would think so. And then if there's a way that we can recover that interest and give that back to your family in a tax-free manner, wouldn't you want to know about that? That's also a great strategy. Now, this is available to you business owners out there. But the first one is, again, like I said, we want to make this work, it has to be a bona fide loan between the business and you. And you're going to want to have a written agreement set up. And again, that loan rate must be reasonable. You can't go charge 50%. That would not be reasonable. But 12%, even higher, up to like about 20% is pretty reasonable. So that's the return that you could get on your money rather than losing it to those opportunity costs and everything else that we have just discussed. Now, each business is different. So if you would like me to sit down with you in your business and see how this could play out for you and help you to your advantage, please give me a call at 215-660-0288, or you can visit my website at dsfinancialstrategies.com. So I'd love to hear from you and see if I could help you. As always, I hope you enjoy your weekend, and I keep empowering you to live a happier, healthier, and wealthier lifestyle. Have a great day.